Now we begin at the center, that is, the central banks. They play a special role. They are needed, but they are also criticized for the moves they make. The main goal for them is to keep growth stable by adjusting the home interest rates. When rates are high, people and businesses are less likely to borrow and spend. When rates move lower, that encourages more spending. But it also raises the issue of bubbles. For example, the recent credit bubble that burst in the U.S. housing and mortgage market is one concern. The United States Federal Reserve is, of course, most closely watched of all the world's central banks. What the Fed does, many others follow. And what the Fed says can matter even more. Daniel Ryntjes sets the stage for us with one of the world's most powerful central banks. And he looks at how its plans can affect your business.
Good afternoon.
When your job is to adjust the available supply of the world's most used currency, the words you choose to describe any changes to that supply have the power to move global financial markets. And in June, these were the words that moved the markets.
If the incoming data support the view that the economy is able to sustain a reasonable cruising speed, we will ease the pressure on the accelerator by gradually reducing the pace of purchases. However, any need to consider applying the brakes by raising short-term rates is still far in the future.
The traditional way to control the US money supply is to adjust the federal funds rate, the rate which banks use to lend to each other. That's likely to stay the same, an ultra-low 0 to 0.25%. But the Fed may scale back its unconventional strategy to boost the US economy called quantitative easing, the purchase of US treasuries and mortgage-backed securities.
It looks as though the Fed will be buying bonds at least at a slower pace. They'll continue to buy them, presumably, but not at the $85 billion a month pace.
Fed Chairman Ben Bernanke made it clear that any tapering of the central bank's bond purchases will depend on improvements in the economy and jobs, but markets have responded as if the Fed has already started to put on the brakes, as Bernanke puts it.
I don't think he intended for that sort of reaction from the market, but once you get it, it's not easily reversed.
So economists don't expect a radical change in policy while unemployment remains high and the perceived risk of stoking inflation remains low. Daniel Ryntjes, CCTV, Washington.